Real estate financing. Most people do not have the ready cash on hand to purchase real estate without financing. While no one claims that you should be as knowledgeable as a mortgage loan originator, the fact is, the better you understand some of the challenges of real estate financing, the more likely you are to be able to offer assistance and direction through this often frustrating process. In this review, we'll take a quick look at the mortgage industry and review some key federal laws. We'll discuss the documents used to finance the purchase of real property and identify typical clauses. We'll examine different types of mortgages and loan programs available. Then we'll discuss real estate financing from a more practical perspective as we review the loan process and qualifying standards. Finally, we will discuss what happens in the unfortunate event that a borrower is unable to repay the loan. Monetary policy is the government's way to control the supply and cost of money. The Federal Reserve, referred to as simply the Fed, does not set the interest rates charged to borrowers. The Fed does, however, regulate the flow of money and influences interest rates offered by its member banks by setting the discount rate, through its open market operations, by controlling reserve requirements, and through moral suasion. The process of originating, processing, underwriting, closing, and funding a mortgage loan occurs in the primary market. This is where borrowers and lenders come together to negotiate terms and transact mortgage loans. Mortgage banking companies are institutions in the primary market that specialize in making mortgage loans to consumers. Unlike other financial institutions, they do not take deposits from customers. A mortgage broker is a company or individual who, for a fee, negotiates, processes, or places loans with lenders. Mortgage brokers do not service such loans, nor do they underwrite or fund their loans. Secondary markets are private investors or government enterprises that buy and sell real estate mortgages. When the secondary market participants buy mortgages from local banks, those local banks then have more money to lend again to other potential homeowners in their area. The main participants in the secondary market are Fannie Mae, Freddie Mac, and Ginnie Mae. If a loan meets all Fannie Mae and Freddie Mac guidelines necessary to be sold into the secondary market, it is called a conforming loan. The Federal Truth in Lending Act, or TILA, is implemented by regulations. TILA requires that a lending institution disclose to the borrower the actual, total costs involved in acquiring credit. TILA applies to all real estate loans made to consumers, not companies, primarily for personal, family, or residential purposes if the loan is subject to a finance charge or payable by written agreement in more than 4 installments. It does not apply to loans for business, commercial, or agricultural purposes. Regulation Z regulates the advertising of consumer loans. If any triggering credit terms are advertised regarding a real estate property listing other than a purchase price and annual percentage rate, or APR, Reg Z requires full financial disclosure. Full disclosure includes the down payment requirement and APR, type of loan, such as conventional, FHA, or VA, terms of the loan and monthly payments, loan origination fees and discount points, and mortgage insurance premiums. The Real Estate Settlement Procedures Act, or RESPA, requires disclosure of estimated closing costs. Lenders must give borrowers the loan estimate disclosure, as defined by the TILA-RESPA Integrated Disclosure, or TRID, rule, within 3 business days following the date of a completed mortgage loan application. The Equal Credit Opportunity Act, or ECOA, prohibits lenders from discriminating in granting credit to individuals and businesses based on race, color, religion, national origin, age, sex, marital status, or receipt of income from public assistance programs. The ECOA requires creditors to notify applicants of their lending decision, whether credit was extended or rejected, within 30 days of the filing of a complete application. There are two types of documents used for real estate loans: a financing instrument, typically a promissory note, and a security instrument, such as a mortgage or deed of trust. Both the promissory note and security instrument are considered contracts between the borrower and the lender. Promissory notes represent the borrower's promise to pay a specific amount of money to the lender within a specific time frame. A promissory note could be structured as fully amortizing or straight, which requires interest-only payments and a balloon payment at the end of the term. Regardless, the interest due is calculated as simple interest, which is based only on the loan balance. It does not compound. Security instruments give creditors the right to sell the collateral property to satisfy the debt if the borrower defaults. A borrower gives the security instrument to the lender to pledge the property as collateral without giving up possession. This is known as hypothecation. A mortgage creates a lien against property to secure payment of a note. Trust deeds, or deeds of trust, are held by a third-party trustee for the lender, referred to as the beneficiary, as security for payment of a with a land contract. The seller, called the vendor, holds legal title to the property as security, not just a lien. The buyer, called the vendee, may possess the property but has only equitable title. Once the purchase price is paid, the buyer receives legal title and a deed. Land contracts are also known as installment sales contracts or contracts for deeds, among other names. An acceleration clause in a note or security instrument allows the lender to declare the entire loan balance due immediately because of borrower default or a violation of contract provisions. This process is sometimes referred to as calling the note. An alienation clause, also called a due on sale clause, gives the lender certain stated rights when there is a transfer of ownership. This is designed to limit the borrower's right to transfer the property without the lender's permission. Upon the sale or transfer of a significant interest in the property, lenders may be able to accelerate the debt, change the interest rate, or charge an assumption fee. A typical loan is made up of two components: principal, which refers to the base amount of the loan or the amount originally borrowed, and interest, which is a charge for the use of money. Usury laws are state laws enacted to protect individual borrowers from being charged excessive interest rates by lenders. Amortization is the regular reduction of the balance of the loan as the borrower pays off the principal owed. Over the term of a fully amortizing loan, regular payments are applied first to interest and then to the principal amount. Initially, more of the monthly payment goes to the interest payment and less goes to principal reduction. If all payments are made on time, the loan will be paid off in full after the last scheduled payment. A straight loan or interest-only loan is not amortized. When the term ends, the borrower must make a balloon payment for the entire fixed-rate loans have interest rates that remain constant for the duration of the loan. Most fixed-rate loans are locked in for a long period, most commonly 30 years. A lender will usually offer a lower interest rate for a loan with a shorter term, such as 15 years, because shorter loan terms are considered less risky. Adjustable rate mortgages, or ARMs, let lenders adjust the interest rate periodically. The lender picks an index that adjusts to reflect the cost of money. It is added to the agreed upon margin to determine the rate paid on the loan. Because arms shift the greater risk of interest rate fluctuations to the borrower, lenders normally charge a lower initial interest rate. The rate or payment can be capped. Negative amortization occurs when the balance grows but payments do not keep up with the rate change. The word mortgage can be prefaced by different words describing its type or function. For example, a bridge mortgage is a temporary loan that occurs between the termination of one loan and the beginning of another. A package mortgage includes personal property. A blanket mortgage is for more than one land parcel. A reverse mortgage allows qualified homeowners aged 62 or older to convert equity in the home into a monthly cash stream or line of credit. The mortgage is repaid if the home is sold, if the borrower does not occupy the home for 12 consecutive months, or if the borrower dies. A budget mortgage combines principal, interest, property taxes, and property insurance. Premiums, known as PITI. PITI also considers any homeowners association fees required as a condition of ownership. The monthly payments for insurance and taxes are held in an escrow account so the lender can ensure payment. Lenders may also require flood insurance if the property is located in a designated floodplain. A construction loan is a temporary loan used to finance the building of improvements. Generally, an appraiser will value the property for a construction loan by evaluating the building plans and specifications, completing a subject to appraisal. When construction is complete, the appraiser verifies that specifications have been met, and the original opinion of value is valid. Then the loan is replaced by a permanent amortizing loan, called a takeout loan. A loan assumption allows the buyer to take over primary liability for the seller's outstanding loan. The lender may accept the assumption and leave the loan terms intact. The lender may choose to increase the interest rate or charge an assumption fee. The lender could also reject the assumption and call the note. Of course, borrowing money involves fees. Points are 1% of the loan amount. They increase the lender's yield and are paid for many reasons, such as an origination fee. A borrower can choose to pay discount points at the beginning of a loan to reduce the interest rate charged. Discount points allow a borrower to prepay some of the interest in return for lower monthly payments. They also increase the lender's upfront yield. Next, we'll contrast conventional loans and government loans. Conventional loans are not insured or guaranteed by a government agency. Traditional conventional loans are long-term, fully amortizing, and fixed rate. Conventional loans are classified by the relationship between the loan amount and the appraised value or sales price of the property, whichever is less. This is known as the loan-to-value ratio, or LTV. When the LTV is greater than 80%, the lender will require borrowers to pay private mortgage insurance, or PMI. PMI compensates the lender for losses if the borrower defaults on the loan. PMI allows borrowers to get a loan with a lower down payment while providing lenders a degree of security. The Federal Housing Administration, or FHA, insures loans for 1 to 4 family owner-occupied dwellings made by approved lenders. FHA-insured loans offer less strict qualifying standards than a conventional loan, including a minimum down payment of 3.5%. All FHA loans require borrowers to pay a mortgage insurance premium. Properties subject to an FHA loan must be appraised by an FHA-approved certified appraiser. The 203B loan is the FHA's basic fixed-rate loan. HUD limits maximum loan amounts for 203B loans based on median range housing costs for each area of the country and the number of dwelling units. FHA-insured loans cannot include a prepayment penalty. The U.S. Department of Veterans Affairs, more commonly known as the VA, guarantees loans to purchase or construct homes for eligible active service members and veterans, and in certain circumstances, surviving spouses. Entitlement is indicated in a certificate of eligibility issued by the VA. VA guaranteed loans are available for single-family homes or multi-family residences with up to 4 units if the veteran intends to occupy one of the units as the primary residence. VA loans may be available with no down payment and they cannot include a prepayment. Rural Development is an agency under the U.S. Department of Agriculture that offers various assistance programs for both businesses and homebuyers in rural communities, which can include small towns and areas hit by natural disasters. Now that we've reviewed various loan types and loan programs, let's consider the process of obtaining a loan. With pre-approval, a lender evaluates an application and indicates the borrower can obtain financing for a specific amount. Only a lender can pre-approve a borrower. To ensure a borrower has enough income to repay a mortgage loan, lenders verify that monthly income is stable and durable. Debt is any recurring monetary obligation that cannot be canceled, such as a car loan with more than 10 payments remaining. Lenders consider 2 ratios to qualify the borrower for a mortgage. The housing expense ratio is the borrower's gross monthly income compared to their total monthly gross housing expenses of PITI. Remember, PITI includes principal, interest, taxes, and insurance. The debt to income ratio is the relationship of the borrower's total monthly debt obligations of PITI and long-term debts to income. The smaller of the two numbers will be the maximum mortgage payment for the borrower. Note that qualifying standards can change, so always consult with the lender. The Uniform Residential Loan Application allows lenders to collect pertinent information about the borrower and the property. Lenders may ask for 2 years of tax forms or other financial statements. Lenders generally require verification of assets to ensure the borrower can make the down payment. If the down payment is a gift letter is required. Borrowers usually need sufficient cash reserves to cover 2 months of PITI after closing. Lenders use credit reports to approve or decline a loan application or put it into a high-risk category. A FICO credit score also helps determine creditworthiness. The higher the score, the more likely the borrower will repay. Mortgage underwriting determines if there is sufficient value in the property pledged as collateral to assure recovery of the loan amount in the event of default. Mortgage underwriting also determines if the borrower's overall financial situation indicates a reasonable expectation of making the proposed monthly loan payments promptly. If a loan application has conditional approval, it usually requires additional items, such as a closing statement from the sale of the buyer's previous home, a financial inspection report, or a commitment for private mortgage. When a borrower defaults on a loan, the lender can accelerate the debt and initiate a foreclosure action to sell the property. Judicial foreclosure requires court action. Most states have provisions that allow borrowers to redeem the property before a foreclosure sale, and sometimes for a period of time after the sale. Non-judicial foreclosure is available when a trust deed includes a power of sale clause. It allows the trustee to sell the property without going through the courts. Generally, there is no right of redemption after a trustee's sale. Lenders may be able to pursue a deficiency judgment. This court-ordered judgment creates a lien against the borrower's personal and real property to pay for the loan amount and other costs not covered by the proceeds from the foreclosure sale. There are alternatives to foreclosure. A deed in lieu of foreclosure allows a homeowner to voluntarily convey ownership of the property to the lender by signing over the deed, at which point the property can then be sold to recoup all or part of the lender's losses. A short sale is another possibility. With this, the lender agrees to accept less than the loan balance when the property is sold. A short sale can have wide-ranging consequences, including possible tax liability for the amount of reduction in value or a possible deficiency judgment. Therefore, licensees should suggest that the seller consults with an attorney, tax consultant, and/or credit That concludes this review of real estate financing. As a real estate licensee, you can have a positive impact on this aspect of the sales transaction by ensuring your buyer clients have the required documentation and that they meet the deadlines stated in the purchase agreement. Transparency with all parties is important. It helps to be proactive and reach out to the lender or mortgage broker if necessary to keep the process moving.